Why are these my top conviction stocks for 2026? And spoiler alert, Target is not going to be one of them. For those of you who are going to be shocked and fall off your seat, I get it, but it is not one of my highest conviction stocks, even though I believe in it. So stick around. I'm going to go into the companies that are my highest conviction going into 2026. Hello, my YouTube friends. My name is Adam Kahn, and this is Investing with Adam K. So, while we approach 2026, I thought it was a really good time, especially with the market pullback over the past 2 weeks, to go into my highest conviction stocks for 2026, the things that I'm looking at, and why I really love these companies. And I know I joked originally, Target really isn't one of them. I know I talk about it all the time because I like the financials. And the reality is, I kind of diversify because I want to not go too hyper focused in the things that I really like, mainly because of the age that I'm getting to and not wanting to take on that type of risk. Otherwise, if I was younger, I probably would have almost all of my money in these companies and just hope that I outperform. So stick around. This should be a great video today. So the first stock that I'm going to talk about, which is a beast in my mind, is UnitedHealthcare. Now, you guys have heard me talk about it before. Stick around while I go through it because I'm going to get into the financials as well this time instead of just talking about the ethereal things that I like about it as an investment. So let's go back over the recent history a little bit and what happened with UnitedHealthcare to make it the bargain that it is now. So it started with the CEO getting killed. Now, this is a terrible thing. I hate to talk about it in terms of just analyzing the stock price, but unfortunately, it all goes into valuation. So it is just an analysis. This is not a judgment or discussion about right and wrong, although I might mention some things. But the CEO got killed by a guy who thought what they do is just terrible for the world and thought he was doing the world a favor by killing the CEO. That started to drive the stock price lower. Then they got a lot of negative news going into this because people really don't like the healthcare companies and what they do and that they are profitable on people's getting sick, essentially, and their job in some form is to actually not pay out when they should be paying out. They have to go through all the claims and figure out who's telling the truth and who's trying to take advantage. And unfortunately, there are probably some legitimately tough decisions. And if you want to be cynical, maybe they just try to deny everything. Like, I don't work for the company. I have no idea what goes on. Again, this is not information I have to, and I have no opinion on it. I'm just having an open discussion about it. But that created a lot of negativity where I'm sure a lot of investors wanted to see the stock do poorly. You then start going forward, and they started to have a lot of chaos in the company too, as well as some tough earnings, which they hadn't had in the past. This continued to drive the stock lower and lower. You add to it that the CEO that just came in then ended up leaving. And on top of it, then the Department of Justice started investigating. And unfortunately, when the Department of Justice starts investigating you, usually where there's smoke, there's probably a little bit of fire as well. All of the negative news and everything going on in United Health took a stock that was trading over $600 a share down to below $250 a share, which I see as a great opportunity. There were a lot of negative things going on. The news was bad. On top of that, like I said, people were rooting against it, which helped to drive it even further. It had to make some people really happy to see the stock do really poorly. Now, my analytics before diving into the numbers is that's a lot of negative on a stock to drive it in half. And I don't see much changing in the actual company's operation outside of the CEO changes and having to deal with the problems outside of things. But the actual revenues and what goes on probably weren't being impacted a whole lot because my thought process is if you're a company with a bunch of employees who uses United Healthcare as your provider, you probably didn't transition out of them to get with somebody else simply because of what was going on in the news. Now, maybe you did randomly for other reasons. Maybe there was better options out there. But I'm guessing if you're MGM, who I have no idea who they use, again, that is not a, but if that was who you use, other than your normal negotiations, I don't think what was going on in the news had impact on their earnings and you making a decision as to whether you're going to use them for your employees or not. So I imagine, which I looked at, their revenue is pretty solid. And to be fair, it just goes up and to the right. Like it just continues like a beautiful chart that I would want to see. And then your opportunity between the PE driving lower and the dividend, which used to not be so significant, being significant all of a sudden, and they grow it at a high rate. So let's dive into the numbers real quickly because, like I said, I love that dividend. I love the pace that they grow it at. And here's some things that I look at that makes me really love United Health. And again, why it's one of my largest conviction stocks going into next year. So price to earnings right now is 16.69. Now that's a deal. To be fair, it used to trade 27, maybe even 28 for a long time before all this stuff started going on. So to be able to pick it up in the 16s for me is a bargain. And the company continues to grow. Like I said, the earnings or the revenue continues to go up and to the right. That's one of the things I love to see, is that despite all the news and what was going on, their revenue just continues growing at a quick pace or at a decent pace. Price to sales, 0.67. Price to book, 3.03. Price to cash flow, 19.84. Now, return on assets, only 5.98. But to be fair, like, they don't really invest in assets like that. They're growing their revenue based on the sales of their, I don't know, I'm getting a brain fart. I hate when that happens. But essentially selling their policies to you and me. Return on equity, 18.48. So it says the return on equity for UNH shows that it is able to reinvest its earnings more efficiently than 85% of its competitors in the managed healthcare industry. So pretty good. I mean, even though the numbers look low to me, I guess for the sector that they're in, that's pretty strong. So gross margin, it's not showing it. Operating margin, 6.03. EBITDA, 7.04. And net profit margin, 4.22. So to be fair, for a lot of us who think the healthcare companies rip us off, if they're only making a net profit margin of 4.22, that does give an idea of how low things are in that industry. And as indicated by its operating margin, UNH controls its costs and expenses better than 73% of its peers. Which again, for these big, large companies, that's probably really how they're able to drive their profits, is keeping their costs down. Another thing that I really like about United Healthcare is when I look at the insider activity. I see very few shares and very few sales, and I actually see legit purchases, not even just award of stock options, but if I limit it down to just purchases, back when all the things that were going on that was terrible for the company, one, two, three, four, five, six, well, five different board members, including the president and the chief executive officer, bought a bunch of shares. Anywhere from a stock price of, let's take a look and see, an average price of 290s, but anywhere from as low as 271 to as high as 320 back in May of this year. So that shows a lot of conviction despite all the negativity that was going on. And my other understanding is a lot of politicians were buying in as well. And these are actual purchases. And when I look at the size of the purchases, they're anywhere from 5 to 10% of their total stock shares owned. So these are significant buys from people who already own the company. And typically when you have a huge position in something, you don't add on to it unless you think it's a bargain as well. Now, it's also showing that Stephen Hemsley, the chief executive officer, bought over 86,000 shares, which he has a little over 1 million shares. But again, that is a huge purchase for a guy who has that amount of shares. You're talking about another 7-8% of his portfolio going into one stock. and I'm not sure how well diversified he is. So that shows a lot of conviction. And I don't know if I mentioned it before, but my understanding was that a lot of politicians were also buying into it. And I'm guessing these guys have a little bit of insight as to what's going on with the Department of Justice, their accusations, and what they think that that's going to end up being, or what type of hit they're going to take for whatever wrongdoing that might have been going on. So really, I love UnitedHealthcare. I think at this $320 a share range that it's a great deal right now. And I also think it has a potential to get back below 300. I think options are a way to look at it because they're a little bit elevated still. And I think there's real opportunity here. Again, one of my highest conviction stocks for 2026. I have a good position in it. I put it into a retirement account of mine so I don't even watch the stock price too much. But I love United Health and I'm tempted to add on to it. Number two on my list is Google. Now, this is actually a really tough one for me because despite how much I love Google, I've watched it go from a 17.5 PE to almost a 30 PE, which is no bargain anymore. But they're growing at a great pace. They have a huge array of companies under their umbrella that I'll go over. I'm also going to discuss their fundamentals and their numbers a little bit. But Google's just such a great company. It's one of my largest holdings, and I'm really not going to add on because of where the PE is currently, but I'm not planning on selling it. I love the company, and going into 2026, it is also one of my highest conviction stocks. So while I do not plan to go through the entire list because as of March 2025, Alphabet has acquired over 200 companies, which is way too many to go through in the short video. But we'll go through some of the biggest, and it's really amazing looking at how much Alphabet has grown and some of the companies under their umbrella. So Investopedia goes over 7 key companies owned by Google, part of Alphabet. They seem to leave out Android, which I think is a significant thing to not forget about. But they talk about Mandiant, Fitbit, Looker, Nest, Waze, DoubleClick, and then of course YouTube. All of these are great companies that are all a part of Google's umbrella. Mandiant, I wasn't really familiar with, so I read about its cybersecurity, which makes a lot of sense to help them with their cloud and the things that they do on that level. Obviously, a lot of us use and know what Waze is, which is a great app for being able to drive and kind of beat the traffic and giving us the best direction to go. And then YouTube, which I've become not just a creator on, but I am a huge absorber of content as well. It's my go-to place to kind of watch TV in my mind. It's really changed over the years. My son used to use YouTube when I wasn't, and I thought it was kind of silly. But it's amazing how once you get into that ecosystem, you're able to search the content that you're interested in. And I don't really watch TV so much. I mean, I watch Law and Order, but I watch movies and then I come to YouTube to search things like when I travel, there's incredible information. And then obviously I can search all the information I want to about finance and just delve into it. And my wife can search the things that she loves too, which is kind of cool for all of us. Although I guess you kind of start watching your own thing instead of watching together. Now, what I do find kind of interesting is I've watched that PE change from 17.5 to close to 30, is how the rhetoric and the conversation on CNBC and the other have changed. So when it was near the lows, they were talking about how AI is going to make Google obsolete, which is their main revenue source, the Google search engine. While the other parts are a big part of the company and they're continuing to grow some of those at a more rapid pace, Google still drives a lot of the revenue. And what they were talking about is how things like ChatGPT and all these other things are going to start eating into their profits, and Google may eventually be obsolete. Now, the CEO kept saying, first of all, our search is continuing to grow. And not only is it continuing to grow, it's growing at a really good pace. So I don't know why you discount it to begin with. On top of that, you add into it that he had an opinion that there's no reason that others can't do well as them continue to grow, which makes perfect sense to me. Now, what happened was the rhetoric is now that Google may be the best in the bunch in terms of AI, and they may be the one that people end up using in terms of search going forward, which, duh, of course, the one that people already use might be able to rise to the top and beat out their competition, even though there are these new exciting companies coming to the forefront that may eat into their revenues. So I think it was just an easy one to kind of pick out of the bunch and recognize that there's no reason that Google wouldn't have been one of the best because they have great engineers and they're going to figure it out. So Gemini is now the thing that people, I guess, are going to when they're doing their AI searches. And all of a sudden, ChatGPT is second tier. So it's kind of like the Burger King to McDonald's, for lack of a better comparison, where now people seem to think Google may be in the race for the AI stuff, which, like I said, there's certain companies that seem really obvious about. So I don't understand why Google was getting so discounted. It does make me, it makes it a tough decision to actually add on up here. But let's look at their numbers, because obviously they have an incredible balance sheet. They make tons of money. But the thing that bothers me that it makes it tougher to invest, price to earnings being 29.98. Now, they are growing at a good pace. So I don't think that that's a ridiculous valuation. I have a much tougher time with Costco, that I love as a company and want to invest in, but I think they're just valued too high. Google at 30 times earnings, it's a little bit frothy, but they grow at a decent pace, so I think it's a little bit frothy. If I didn't have a position, this is a company I just want to own. Price to sales, 9.38, price to book, 9.35, and price to cash flow, 22.21. It says that their PE ratio is comparable to other companies in the internet service industry. I'd have to do a little more research to see if that's accurate, but they're huge. And if some smaller companies that are growing at a faster pace are discounted, that might be a really good opportunity as well. Again, I just think they're one of the greatest companies, so I want to own them. So return on assets, 25.71, return on equity, 35.45, return on investment capital, 31.60. So when a company the size of Google can still make investments and get a 30% plus return, to me, that just blows my mind away. So the return on equity for Google shows that it is able to reinvest its earnings more efficiently than 90%, 93% of its competitors in the internet space. Now, then it gives their typical little comment of like, that means people are willing to pay more for it, which, okay, genius. Gross margins. I love this. And I love this stuff about some of these big tech companies. 59.17. Operating margin, 32.19. EBITDA, 38.82. And net profit, 32.23. For a mature, huge monster to be making 32% for net margin, that's so crazy. So gross margin is comparable to other companies in the internet security space. As indicated by operating margin, Google controls its costs and expenses better than 96% of its peers. Now, I would say, other than typical brick and mortar companies, when you start looking at internet companies and online stuff, that should be the case, that as they grow and they're bigger, that's part of what allows them to be able to control their costs. So I think it becomes really difficult to compete with the mega caps. It's why I love companies like Google. And the next one I'll talk about is Meta, which I also talked about yesterday, because I see that one as a bargain right now. Now, I already spoiled it. My next conviction stock for 2026 is going to be Meta. I'm not going to dive too deep into it. Feel free to look at yesterday's video, because I did go into it. Really, what I love about Meta is that they're at a 20 times valuation right now, which I just think is a great opportunity and a super steal. I don't know that we're going to get another opportunity like 2022. Back then, it dropped into single digits because everybody hated the metaverse, that he was changing the name, and that they were spending so much on capital expenditure. He then reversed and did, the year of efficiency. And I think that was a little bit of what he was hinting at when he talked at this most recent quarterly report, which is why I find it interesting that the stock fell off so hard. It shows that Zuckerberg knows how to pivot if things start to get too rough on the stock. And it makes me really love it at a 20 times valuation. I don't think we're going to get an opportunity where it just collapses and it falls into the three or four hundreds. I really think where it got to on Thursday and Friday is probably the best pricing we're going to see. And hopefully, I mean, I added on to what was already my largest position that I'd slowly been selling some of it because it was too much of my portfolio. But to be fair, when I saw where the valuation got, to me, it just became really attractive. And I think what he was explaining about his capital expenditure for this quarter and going forward is, first of all, understand they make money, plenty of money to be able to make these investments. Second, one of the things that he was trying to really explain to people is if it doesn't work the way that he's hoping for AI, and in terms of increasing their sales and revenue and growing the business, they're investing in something that they can use for their company anyway. So either way, it really doesn't matter. It's just getting ahead of the game. And either it hits a home run and they crush it in terms of being able to grow revenues, or they need this stuff anyway. So what's the difference? We might as well spend it now. And if you go back to 2022, when he did the year of efficiency, or 2023 that caught the bottom and drove the stock back up, it becomes evident to me that if things aren't working the way that he hopes, it's very easy for him to back off how much he's spending, use that money to grow revenue and income and drive. And they even implemented a small dividend, which I think he'll be able to grow at a rapid pace if he needs to slow down their spending. So I really love Meta, or Google, or not Google, sorry, stupid brain fart. My God, I'm like the biggest idiot in the world. But Facebook, sorry, forgive me. They have 3.5 billion daily users, and they are just a monster. And I don't really see that changing. I actually really liked his vision for the metaverse because it showed me that a guy who already had a business that was becoming a cash cow and generating tons of money wouldn't just sit back and wanted to continue to drive forward. Now, I did a video years ago and talked about the metaverse and the vision that I think he saw. Now, I have no insights. I'm not buddy with Mark Zuckerberg. It'd be cool to chat with him, but either way, when I think of what he was doing with the metaverse, and his goal was entertainment type value. So when you use the Oculus and you see that 3D and the ability that it does, my brain starts going crazy for things like football games or basketball games, and then even how schools can work and things like that. Now, imagine we get to a point in the future where instead of actually going to the game, you could pay through for seats in your Oculus. And maybe you want to sit on the 50-yard line, which would be a little bit more expensive than sitting up in the nosebleeds. And then there could be advertisements during the game. And with those things, you're like there at the game. You can look around behind you. You'd see the people sitting next to you. You'd see people selling stuff. You'd see the game the same way you could if you were at the game. And it can be way less expensive without having to drive in or do any of that. So that's what I think could be really cool about the Oculus. You then add on to it, like the quarter comes around and maybe there's an advertisement from Pizza Hut or Domino's or whoever about getting your pizza and wings at the halftime show, or beer, or whatever it is that you could then have delivered to your house. So I see tons of opportunity with that thing. I know we've transitioned away from it, and he's not talking about the metaverse so much, and now they have their Ray-Bans or whatever it is. But I do think that was kind of what he envisioned. And then in my mind, you add that stuff for travel or even school, with all the things that parents worry about for their kids. What if they could put on an Oculus and go to school, and, what's that guy? The science guy could be your teacher. Mark, he does with the squirrels and the foam and the other stuff, who's just incredibly entertaining. But imagine a scenario where you could put on your Oculus and he's your science teacher who makes it fun and exciting, and keeps your kids entertained, and they still have homework that they hand in, and it could be graded by AI that they're creating. Like, all of this stuff could still go on. And just an amazing way that I think Mark Zuckerberg kind of saw the future. Maybe I'm wrong, but there is an avenue there. And while everybody hated on him for all of that spend, I liked that he still had vision and still wanted to grow a company. instead of just laying back and be happy with the revenues coming in, turning into a big old boring dividend company, which they could have, that still would have grown and still would have driven revenues and still would have done just fine. But it shows me that he still wants to grow the business. And not only do I love Meta, not only is it one of my highest conviction stocks always, going into 2026 with the valuation where it is right now, I think it's going to have a great year. I'd like to see it get above 800 by the end of the year. Again, this is not financial advice. I am not a financial advisor. Please do not listen to me when it comes to making any financial decisions for your own account. You need to do your own research. You need to talk to your financial advisor, and you need to figure out what works for you. Because quite honestly, I plan to have a discussion with my financial advisor about the things that I want to do for 2026. I'm trying to decide, do I want to go more dividend oriented? Do I want to just let things be? Do I want to start pushing towards more growth, but using dividends or using options to get a dividend on some of the things that I have the highest conviction on? And I'm even going to reach out to my financial advisor, which is why you shouldn't just listen to me or anybody on YouTube for that matter. So the last stock I'm going to talk about is my highest conviction going into 2026, but I will talk about one more stock as well. But the highest one that I'll include in my list is Nvidia. Now, I hate picking Nvidia this late into their cycle, but I think after the sell-off, after they had killer earnings, anything around $180 a share or below is a really good valuation for a company that is the forefront of what is going on in this AI trend. Now, I hate to just be like AI like everybody else, because I think it's kind of silly, but unlike the .com, a lot of the companies that are involved in the bubble that they talk about aren't so bubblicious. Like, they're getting a little bit frothy, but AI is a legitimate thing that we all have to be aware of and pay attention to. And the fact that the companies that are making the most money are investing as heavily as they are, and there's such smart people doing this stuff, I think you have to trust that it's a legitimate thing. Now, my only concern with Nvidia, only concern, is that the people who buy the product from him are also working on creating their own. Now, I don't think it's just that simple, or they'd have better competitors and more competitors, and their margins wouldn't be what they are. But I do worry, like when I talked about Google, part of the reason I had faith in Google is I think they have some of the top engineers. So I had faith that they'd be able to get the AI stuff going to compete with ChatGPT. I do worry that companies like Google and Meta and Amazon, which are my other highest conviction stocks, will be able to create their own chips and not have to buy them through Nvidia. Now, maybe there is so much demand that they need it from all of them, including their own, even if they figure it out. Because part of what's amazing about Nvidia, as much as they produce, they can't sell enough of them, which is why the margins are so big. So let's look at the numbers a little bit. We all know what they do, and we all know what's going on. The thing that everybody's super concerned about is the valuation. Right now, they're at a 44 times price to earnings ratio, but they're growing at an exceptional rate. And to be perfectly honest, I don't think that is so outrageous for the rate of their growth. I think it's expensive in terms of a typical stock, but Nvidia isn't a typical stock, and that will slowly come down. The reality is eventually that'll be a normal valuation as the growth normalizes, but at least for now, it seems to be growing at an exceptional pace. Now, those of you who like the others, price to sales is showing a 23.23. I like when things do that. 23.23. Price to book, 36.57. Price to cash flow, 33.18. Now, Nvidia's PE ratio is greater than 66% of the other companies in the semiconductor industry. Now, I get it, and that's my concern, and that's everybody else's concern, is that they're overvalued, but you're paying for the company that's doing the best. Return on assets, 77.15. Now, wait until you hear this. Return on equity, 107.36. Uh-oh, I think our power just went out, or somebody did something. So I'm going to have to hit pause. Give me a minute. Well, that was a little bit strange, and those of you who know me get used to, I just kind of work through that stuff instead of editing it out and changing it. So we had a bit of a power glitch, kind of like when my brain farts too. Things just happen from time to time. Anyway, so if I repeat something, I apologize, but the return on equity for Nvidia shows that it's able to reinvest its earnings more efficiently than 100% of its competitors, which is kind of my point as to why the PE is too high. They are the best of the best right now. The fact that they're making a 100% return on their equity is just absurd. And their return on investment capital is 92.4545. So they are just hitting it out of the ballpark and going forward on all cylinders. Their gross after the power shuts off like a brain fart, all of it. I'm just an idiot now. Oh, I should do this thing. I'm just an idiot, probably the biggest idiot on YouTube. Anyway, gross margins are over 70%. I mean, that's just unbelievable. Again, internet type company. These guys, like when I talked to a buddy about it and said, what's amazing about them is their ability to expand is so much different than the companies in the 40s and the 50s and the 60s, where if you were like GM or Ford or a company trying to expand back then, oh, let me make sure the microphone's on after screwing all that stuff up. It was different. As you started to make more revenue, you had to buy more land and build more buildings and do this and do that in order to be able to grow and sell to new people. Well, these guys, like, they just need more office space and more computing ability. They don't need to actually expand in terms of buying more buildings and land and investing in more cars and factories and whatever else. It's so much easier for them to be able to expand. It just changes the dynamic so much, and the margins are so incredible that I don't really see that being a hindrance in these companies getting bigger and bigger. So part of this time is different type of stuff, like this time it is different. It doesn't mean these companies can't broaden their reach and they can go international and they don't have to go there. Whereas if GM wanted to sell cars in China, they have to actually send the cars to China. This stuff is so much different. Operating margin 58.84, EBITDA 60.49, and net profit margin 53%. So that's why Nvidia is so amazing. It's also why I worry about companies like Google coming up with their own chips, because they know that these margins are there, and if they're making 50% return on the stuff that they're buying from them, they're going to do what they can to try to build them themselves. So Nvidia's gross margin is more than 93% of other companies in the semiconductor industry, which means it has more cash to spend on the business as opposed to its peers. It's indicated by its operating margin. Nvidia controls its costs and expenses better than 100% of their peers. So they really are the best. It will slow down at some point. Like, this won't go on forever. But at least for now, they are just crushing it. And they are a great company. And 44 times earnings, even though it's frothy in a lot of our brains, I'm not super uncomfortable paying that. Full disclosure, I did pick up a little Nvidia this past week. I sold some puts as well. If you like using those types of strategies, I did a month out, the $150 put. I also did like a weekly 160 in case it continued lower, as well as bought a few shares. I like the company. I think at least for now, they're going to continue to grow. At some point, they could have a huge correction, but in terms of the next year, they are one of my top convictions for 2026. So the outlier that I'm going to talk about that is a little bit different and a little bit harder to analyze is CrowdStrike. What I love about CrowdStrike goes back to the blackout and then their outage going a few years back. Now, I like Palo Alto Networks as well, and I have a decent position in my set it and forget it account. I have a much smaller position in CrowdStrike because I wasn't as comfortable with them. But I also think my brother did a great analysis and had a great insight when he talked about that outage. And he bought it when the company collapsed. And his reasoning was, if having an outage is impacting our world this significantly, that tells me how valuable this company is. Now, the only reason it is not one of my highest convictions for next year is I have no price to earnings and stuff in order, and I have difficulty personally. I am not an accountant, and I'm not great at digging into some of this stuff to understand how their growth is even when companies are losing money and how they'll come out of it. So that's why it's hard for me to be super convicted on CrowdStrike, but I think that he's correct that the world needs them and they are going to be super profitable. Their gross margins are also 74%. And when I look at the revenues, I mean, that's the thing that just floors me. Hold on, let me find it. I mean, it's so stupid that I have to even look because what's the difference? But it just is like up and to the right and just this beautiful chart that it's like, oh my God, they just make more and more money year after year. And the projected growth rate from 2025 to 26, 27, 28, and 29 is going from like they don't, oh, here they do. So in 25, they're expected to finish the year making 3.95 billion in revenue, not make. 26, 4.78. That's a pretty good significant increase. 27, 5.83, 28, 7.1, and 29, 8.4 billion. So from 25 to 29, going from 3.95 to 8.43. So more than double their revenue is expected over the next 4 years. Now, predictions are like anything else. Nobody really knows the future. But when I look at their past revenue, man, it started at like 431 million in 2022 and they're up to 1.17 billion in August of 2025. And those are just like every couple of months and stuff when they're talking about it. So it really is just this beautiful up and to the right type of chart. And I don't know what would stop that from continuing forward, which is kind of their prediction model. So CrowdStrike is just a great company. It is a beast. And I think that just continues going forward. I really love the company. I wish I picked up more of it when they had the outage. I picked up a tiny bit more as I'm getting more convicted of them, but I'm too scared to put on a big position because if it's wrong, it really is one of those super expensive, overly crazy, high flyer type of companies. If I was back in my 20s, I'd probably dive into it a little bit bigger. But as old as I am, and as much as I'm starting to focus on retirement and having less risk in the portfolio, maybe it's not the right fit for me to go too crazy with it, but I really do love the company. I just can't put it in my list for next year simply because I don't understand it enough to really take that kind of jump. I'd like to put Target in there as much as you guys know, but as much as I said that in the beginning, I really do mean it. I just like Target because I think they're really fairly valued. I think their earnings are just fine. I don't really see them as a Sears. But I don't think they're one of my highest conviction stocks that I just think is going to do phenomenal going forward. It's more that I use companies like Target, Conagra, Stanley Black and Decker, T. Rowe Price as my version of buying treasuries. I don't mind having the risk of the stock market in my account. I want some dividend yield the same way that I would have it in a treasury bill that technically has as close to zero risk as anything else. And now I'm finding stocks that are paying a higher dividend than what the yield of a treasury would be. And my only risk is that those stocks don't do well and that the valuation goes down. But I also have the opportunity that the valuation could go up, which I don't have in a treasury. So that's really my whole thing with Target. I know I joke about it. I hope everybody knows it's a bit of a joke and doesn't think that I just love it that much. I kind of bang my hands on the table because I think those things are a better opportunity for a treasury, not because I think it's the best opportunity out there. Anyway, I hope everybody had a great weekend. I hope your Sunday is phenomenal. I want to start wishing everybody a happy Thanksgiving. My videos are going to start becoming a little bit spotty because I got my son's official birthday, even though we celebrated it a couple weeks ago. We've got Thanksgiving. We're getting ready to go out of the country. And then once I go, the time difference is going to be so screwy. I don't know how many videos I'm going to be able to get in. Now, don't forget, man, if you made it this far, fuck, I'm floored that you actually made it this far. Whoops, forgive my language. I hope that doesn't mess up the algorithm on YouTube and really mess with my channel. Anyway, don't forget on Tuesdays, 11 a.m. I know that time is terrible for a lot of people because most people work a normal job, but it's super good for me, which is really all that matters. get to put up my little emoji that talks about selfishness. But not sarcastic, it just fits my schedule well. But I am going to do another live. I appreciate that people are beginning to show up. I love that platform. I really enjoy doing lives. I would do them every day or every few days or whatever it was because I like the interaction. I like being able to answer people's questions on the spot. As I'm getting more comfortable working out of my office or doing these videos out of my office, I'll have my computer. So if people want to actually ask me about a stock, I can pull it up. I can get the revenues. I can get the PE ratios and see the income as well as the chart and everything else and give a better answer, even if it's not a company that I'm familiar with. So I'm happy to answer people's questions. But do me a favor and try to make it to Tuesdays live. It's super fun, at least for me. Maybe it sucks for everybody else. I talked about my trading life a little bit, and I'll try to talk a little bit more because my wife tells me that's kind of fun to hear about. Um, but again, hope you had a great weekend. Wishing everybody the best for this week, a great holiday. Please spend some time with your family and remember what's important. And do me a favor, if you haven't already, hit that subscribe button, smash the like button, make some comments in the comment section. Let me know what your highest conviction stocks are for 2026. Billy, some of you, I know what they are. Lance has shared a little bit, but please share again for me and for anybody else who reads the comments. I really do enjoy it, and it helps YouTube's algorithm as well, which I totally appreciate. And it's cool. I like the conversations. I like getting to know some of you, even though we know each other, right? Anyway, have a great week, and I'll talk to you soon. Bye bye.